Welcome back to Selling Your Business with David King. I'm David King. I'm the author of Selling Your Business. Begin with the end in mind. It's available on Amazon. Please like this podcast and this YouTube channel. Today, we have the pleasure of being joined by Channing Hamlet with Objective Capital Partners. Morning, Channing.
Hey, good morning. Thanks for having me. I really appreciate it.
Channing is an investment banker and does business valuations, and he works in Southern California in both Los Angeles and San Diego. So, Channing, why don't you tell us a little bit more about yourself, about your practice, how you got to be where you are?
Yeah, the short version of the story is I started doing investment banking in the mid 1990s in Philadelphia at a large firm called Legg Mason. And I had the opportunity to work on a whole host of different corporate finance activities from public offerings to debt placements, fairness opinions, et cetera, and really specialized in doing mergers and acquisitions work. And the group I worked for in Philadelphia had a really strong kind of lower middle market, family held sell side practice. And so I learned right at the beginning of my career to work with and represent entrepreneurs and families going through a sale process. And, fast forward, I guess over 25 years now, which makes me feel like an antique. Still kind of, moved across the country. I've done a stint in private equity, and then I've been doing investment banking and business valuation in San Diego for about 20 years now, and still doing business appraisal work and representing families and entrepreneurs as they look to exit and sell their companies.
Well, then you're one of the fortunate ones then, because your big firm experience is relevant to what you do today. I personally I started on Wall Street, big firm activity there, and it kind of the work that I was doing for investment banks, your Merrill Lynch and derivative securities. It's transactional and it was good experience, but not so relevant to what Main Street businesses and what middle market companies are doing with their exit strategies. Got a little bit more of that when I worked in Silicon Valley with a firm there, but sounds like your experience from day one has been relevant to what you're doing now with middle market companies doing mergers and acquisitions and other forms of transactions.
Yeah, it's actually interesting you asked that question. My first job out of college was working for a strategy consulting firm, and our clients were Fortune 50 or Fortune 100 companies. And so we worked with people, executive teams, and boards of directors at these companies on their most pressing strategic issues. And the people we worked with were very, very sophisticated, and they hired us for a very narrow task. And then I shifted gears in my career after doing that for a couple of years and got involved in investment banking. And part of my experience at Legg Mason was working with larger public companies, and I certainly worked on billion-dollar deals. But I also got exposed to working with entrepreneurs and family businesses. And the second transaction I closed, we represented a third generation family business in their sale.
Mm-hmm.
And I remember vividly at the closing dinner, in my late 20s, the patriarch of the family pulled me aside and, basically said something like, "Hey, Channing, like really appreciate all the hard work and persistence. You changed our family's life. And I really appreciate that." And, that really, very memorable, and, really kind of fell in love with, working with these smaller companies, less sophisticated, where we could come in and really add a lot of value. And so it's kind of stuck with me ever since, that working with the smaller companies that need help, and making a real difference for individuals that have a stake in the outcome is really important, as opposed to working for some large public company where you make money for some nameless, faceless shareholder. We're actually using the skills and expertise we have to impact individuals and families, and it's really meaningful and rewarding work.
So your sweet spot today, is it a mix of both mergers and acquisition and business valuation? Any particular size?
Yeah, our firm has we have two distinct practices. We have a business appraisal practice, and it's a full service practice. We have teams in Dallas, Denver, Los Angeles, and San Diego. Our clients are nationwide. We're doing all of the typical valuation work from basic 409A valuations and tax compliance, financial reporting, so purchase price allocations and other balance sheet valuations, estate and gift tax valuations, from fairly simple small gifts up through billionaire families that have very complex master limited partnerships where they're doing complex gifting and trust strategies.
mhm.
And then we also do a fair amount of advisory work where we help companies understand what they're worth and what the value drivers are to either to prepare for a transaction. That's our appraisal business. And
Okay.
then we have a second business, which is investment banking, where 95+% of what we do is work with business owners that want to sell their companies, and we help them run a process so that they get the best price and terms. Most of our transactions are valued between 10 and 100 million. Our firm, our investment banking group is about 15 people, and we're closing typically more than 10 transactions a year. The largest transaction we've closed over the last couple of years is north of 300 million, but most of them are in that 10 to 100 million 10 to 100 million range, and that's really the market we focus on. And those are the types of companies that we really enjoy
Mhm.
working with, because like I said earlier, we can make a really big impact.
All different industries, or do you have any specialties?
It's that's an interesting question. We have formalized industry groups. We do
Mhm.
quite a bit of work in business services, and that's a group that I spend a lot of time in, working with companies that provide services and software into the pharma and life science space. We also do a lot in manufacturing and distribution, direct to consumer e-commerce and SaaS software. So we definitely have a lot of expertise in each of those spaces.
Uh-huh.
And then there's a little bit of a generalist element to our business, where what we found is a lot of the smaller companies that are overlooked by the larger investment banks don't necessarily fit into an industry. And so what they really need is a firm like ours with senior people that were trained at larger firms that could come in and roll up their sleeves and work their transaction really
Mm.
hard. So there still is a little bit of a generalist element.
Uh-huh.
However, we do have very significant expertise in the industries that I mentioned.
Help me, is there much of a nexus between the appraisal work you do and the M&A work? I mean, obviously you want the owners to have a realistic expectation of what their business is worth, but do they necessarily need the full-blown appraisal? What do you typically do, if be a one-stop shop for that sort of thing, or give them the amount of support they need on a reasonable expectation for what they should be able to fetch?
Yeah, that's an interesting question. A lot of the appraisal work we do is driven by regulatory or compliance purposes for
Right. Yeah.
tax or financial reporting, and so there are very specific guidelines, whether it's IRS Rule 5960 or USPAP or something like that, that
Hmm.
need to be followed. And so we have a team of experts that really know that stuff and know it well. And then
Hmm.
on the investment banking and transaction side, I would say that work is probably a little bit more pragmatic. And so
Hmm.
I think what I found is that having both areas of expertise under the same roof provides a ton of value for our clients. When we get hired to do a business appraisal, we have the really in-depth technical valuation expertise that most investment bankers don't have.
Hmm.
But we can also combine that with the real world feet on the street, practical deal expertise to add a little bit of a practicality to it. And then on the investment banking side, when we're working with clients that need kind of as part of a negotiation, we're often doing pretty detailed valuation work to negotiate with a buyer.
Yeah.
We have a team of experts that can really help with that, that bring some expertise that the typical investment bank doesn't have. So the two practices work pretty well together in terms of sharing knowledge and expertise.
Hmm.
So that's kind of what I've seen and how it works.
Now, correct me if I'm wrong here. I understand with most investment banking transactions, on the sell side, you don't really want to put a price. You don't want an ask for your company, your client, because that'll serve more as a ceiling rather than a floor. If you got a main street company that's going to be, sold, say, by a business broker or something, they've got to come up with a price or they'd never, be able to generate much of a market. But you're going out, directly to buyers and kind of blind auction sort of thing. Is it true? And I'm kind of obviously have a leading question here, but feel free to correct me.
Yeah, in a typical kind of middle market, I'm not super familiar with the business broker world, although
It's a different market.
I
Yeah.
do understand that an
Yeah.
asking price gets set similar to selling a house.
Right.
In our world, for a typical little middle market transaction, that's 50 million, 75 million or whatever,
Mhm.
we work with a client up front to understand their value expectations,
Mhm.
because it's very labor intensive to sell a company for a premium valuation. And
Uh-huh.
so we want to make sure it's worth our time and worth our clients' time before we start a process. So we do a fair amount of work with our clients to understand what their expectations and make sure that we're all confident that the market will deliver.
Mhm.
So that's some work that we do up front just to make sure it's a good use of everybody's time before we take on the engagement. But
Yeah.
when we run the process,
Mhm.
what we've found is the best practice typically is to let the market set the price. So what we would do is work with the client and really do all of the positioning and create the materials to tell the best story possible on why the company is worth a lot and why it's
Mhm.
worth a premium. And then we go and market the company to the right buyer universe and ask them to make offers. And we run sort of a typical two-step auction process where we would share some materials and ask for initial indications of interest, get offers, then narrow down to a smaller group of buyers that appear to be a good fit and appear to be interested at a high value, and then
Mhm.
work with them to kind of create an auction process where we can negotiate and push the price up. That would be the typical process. And so
Mhm.
we're not necessarily setting a price, we're letting the market set the price, and then we're
Yeah.
we're using a competitive process to drive the price up. And so what we found over time is that process typically by setting that process up and getting multiple buyers really interested gives you the tools to push the price up. And then if you're in the seller's shoes, now you're sitting there, and you're in a position to make a really good decision because you've gone to all of the right buyers. You know
Right.
who's interested, who isn't. You have feedback from the market, and you know that you're getting, the best price in the market available today. And
Mhm.
so that would be a more typical process,
Mhm.
a more typical kind of standard investment banking process. And then there's lots of different nuances and flavors and twists and turns depending on the particular facts and circumstances. But generally speaking, you're right. We wouldn't necessarily set a price and try to go get it.
Right.
We would let the market determine, and
Yeah.
then use clever negotiation to push the price up as high as possible.
Your sim doesn't have an asking price. It
Correct.
describes the
Correct.
business and summarizes the fact. Do
Correct.
most of do most of the companies you take to the market, do most of them have audited financial statements or just reviews or some?
Just one thing on the last question you asked. I think one
Uh-huh.
of the mistakes that we see entrepreneurs and business owners do when they try to sell a company themselves is they set a price too early.
Oh yeah.
And so what happens is they're like, "Hey, I don't want to waste my time dealing with this buyer. I only want to do a deal if they're going to pay a high price." And so they put a high price out, and then it turns the buyer off because
Hmm.
a company that's making acquisitions, they don't have to make the acquisition. They have plenty of other alternatives to work on. And so they're sitting there trying to figure out which opportunities they want to pursue and which ones they don't. And if you show up with what on the surface looks like unrealistic expectations, typically that would turn them off and they'll spend time on something else. And so the way we run the process is we bring people along one step at a time. We educate them on the company, we get them interested, they make an initial offer that might be lower than what we want, and we tell them, hey, you're the right fit. This is a good fit for the following reasons, blah, blah, blah. And we drag them along in the process, and get them interested and invested. And as they've put more and more energy into it and fall in love with our client, that's when you can start to negotiate a price higher. So there's a real art to it that
Mhm.
I think I've seen a lot of business owners, try to shortcut the process and either turn buyers off or shortchange themselves. So that's just a observation or a thought that came up when you said that.
Yeah.
As to your question about audited financials, one of the most of our clients don't have audited financials,
Right.
and it definitely is easier to sell a company when they have
Mhm.
financials, because a buyer can have a lot more confidence in the numbers. And so it is a best practice to have financial audits done for several years leading up to a sale. One of the
Mhm.
things that we've started to see more and more of in the market today is a buyer typically does like 7 or 8 streams of due diligence. One
Mhm.
of the streams is this thing called quality of earnings, where they bring an accounting
Right.
firm in to do due diligence on the numbers and make sure they're real. And so a lot of companies are now hiring an accounting firm to come in and do what's called a pre-sale quality of earnings, where you do all of that work up front and then you present those numbers to the buyer. And now you're very confident that the numbers you presented are going to stand up in due diligence. And
Mhm.
that eliminates the quote unquote retrade that you often hear about at cocktail parties and on the golf course and stuff like that.
Yeah. So talk a little bit more about, and just to kind of throw a little color onto what you're saying about the expectations and that sort of thing that can deter somebody, and this selling a business. I mean, after my years of experience, it's more like being able to make a marriage come together than it is like selling a piece of real estate or another investment of that sort of thing. It's got to be a good match. And having these unreasonable just must haves are kind of as much of a turnoff as when you're looking for that magical combination. Anybody who's got an absolutes on what they really need, well, you're likely to just push the other person to keep going down the road. And you said fall in love. The buyer is going to have to fall in love, and before you close the deal, the buyer is going to discover all the flaws. The deal's not going to happen, but without an adequate amount of due diligence to see what's out there. But you need to make them fall in love before they find the flaws, and play all these things in the right direction here. Don't turn them off by having just all these unreasonable expectations for what are must-haves. Make them love your business, and over time, through the due diligence process, you're going to have to share with them at the right time and place all of these things that are probably the last thing that you're going to want to share. Is that consistent with your experience?
Yeah, it's interesting that you bring this up. And typically running a sale process, you get to a point where you sign a letter of intent.
Mm-hmm.
And that's the turning point in the transaction. Before you sign the letter of intent, there are multiple buyers interested, and the negotiation leverage is on the seller side.
Right.
And then after you sign in the lower middle market, almost all buyers want you to sign a letter of intent and grant exclusivity for 60 or
Right.
90 days. And
Mm-hmm.
then that's when they start to spend money and do their due diligence. And so as soon as you sign the letter of intent and you've given one buyer exclusivity, the negotiation leverage at some level shifts to the
Mm-hmm.
buyer.
Right.
And so there's an art to this, but what we try to do is share as much information as possible before signing the letter of intent, so that we minimize the chance of new issues coming up after the letter of intent is signed, when
Right.
you've given the buyer negotiation leverage.
Yeah.
And so the example I often use is, I sold a house a couple of years ago,
Mm-hmm.
and when we were getting offers from buyers, I filled out the seller disclosure statement and I put all the stuff that was wrong with my house on it, and I sent it to all the buyers. while we were still getting multiple offers and it was competitive. And then, we signed an offer, the buyer comes in and does the inspection, and the inspection report has all the things that I had already told them about.
Right.
And I was like, hey, I told you all about all of that stuff before the offer. Like, I'm not giving you credit for any of that.
Yeah.
That was already baked into your offer.
Yeah.
And so what we try to do is make sure the buyer has like really good clarity on what the business is, what it isn't,
Mhm.
and the good and the bad and the ugly. And obviously, if you're in a sales role, you try to put the most positive spin on it possible.
Mhm.
But the reality is, in the world we're in now, a buyer does 7 streams of due diligence, and
Mhm.
they're not going to write you as a seller a big check until they're very comfortable with everything about the business. And so it's in your best interest to disclose the good, the bad, and the ugly
Mhm.
before you sign a letter of intent, so that you have a lower opportunity to get nickel and dime during due diligence. And that's something that that we work really hard on with our clients.
Right. You don't want to have sign a letter of intent and then have a bomb drop and have to go back and reprice the deal, start all over again. And then
Yeah.
everybody's kind of wasted their time and they're pretty frustrated. So you definitely got the prudent practice
And
there.
the other thing is getting a deal done is largely based on trust. And if
Yeah.
the buyer feels
Right.
like you've intentionally hidden something,
Hmm.
it's much harder to get to the finish line.
Right.
So, we work really hard on, create, still negotiating, still selling, obviously, but, creating transparency and trust as well.
That's the whole marriage analogy too. They are going to find out, better find out from you than from their friends
Exactly.
who already knew.
Yeah. Tell them about all your ex-girlfriends first.
Right.
Yeah.
Well, at least most of them. Yeah.
Some of them. Yeah.
So, quality of earnings, that's a good thing to hit upon here. Can you, if somebody who hasn't, been through the sale process before and you're trying to prep them for this, and the buyer's going to want to look at quality of earnings, stickiness, what sorts of things are we looking at with quality of earnings?
Yeah. I think the short version of it is many companies, not all, but many companies are sold on a multiple of EBITDA. And
Mhm.
so as a seller, you go through and look at the financials and and do create kind of an adjusted or pro forma EBITDA. So if the buyer in the business, they wouldn't pay for the country club and this discretionary expense and that. There was a move in the last year. There was this, there was that. Like, what's the normal EBITDA the buyer could expect from
Mhm.
this business? And so as a seller, you present that number to the buyer. And then the buyer values the company based on that number. And then the buyer would hire an accounting firm to come in and test the quality of that number. So they go and look at the accounting and they make sure all the accruals are done correctly. They understand all the adjustments you made. They may audit various general ledger accounts that are large, et cetera. And then they come up with their view on whether the EBITDA you presented is correct or not, through the quality of earnings process. And so a company that has sloppy accounting processes, or doesn't necessarily follow proper accrual or GAAP accounting has a risk that when an accounting firm comes in to do the quality of earnings, they find places where the company is not in compliance with GAAP, or didn't account for this right, or didn't accrue this expense right, or has this liability that wasn't disclosed, et cetera. And that, creates an opportunity for the buyer to potentially
Mhm.
renegotiate the deal. So that's really what the quality of earnings is. And then the second thing a quality of earnings firm does is they look at where the earnings are coming from. So
Mhm.
they'll do work on, revenue and margins by customer, revenue and margins by service line or product line. Um, they'll look at where there may be reliance on certain special relationships with vendors, or relationships with key people, and
Mhm.
point out a number of the risk points with a company.
Mhm.
And so, we've seen situations where, a company may not necessarily have a customer concentration when you look at a revenue by customer, but if you look at a margin by customer, one customer maybe has 30 or 40% of a company's total margin.
Oh,
And so,
mm,
we've seen issues like that, like that come up. And so a quality of earnings firm is going to come in and look at the key risk, look for and understand some of the key risk points in a business as well. And so it's really valuable for a seller to have done a lot of that work up front. So you truly know all of the you truly know you've got your numbers right and your accounting correct, and then the risk points in terms of revenue by customer, margin by customer, service lines, et cetera, et cetera, et cetera. It allows you to be more confident in the numbers that you're presenting and tell a
mm,
better story, tell a better story to the buyer. And so
right,
that sort of in a nutshell is kind of how I look at and think about the
right.
quality of earnings. And then
Mhm.
over the last 25 years, what we've seen is um, it's often hard to convince our clients that run smaller companies to spend money preparing for a transaction. A lot of entrepreneurs and business owners are like, hey, once it's real, I'll start spending money, but I want to know it's real first.
Too
And so
late.
there's always a tension between how much do you invest to be
Yeah,
truly prepared versus how much do you wait until a deal is real and then be prepared. So there's always a tension, but what we've seen over the last 5 to 10 years is more and more sellers are investing in doing formal pre-sale quality of earnings work, and it makes
mm,
a huge difference in the process. That the numbers that are presented are accurate. The insights that you get from understanding a lot of those things around margins by customer or margins by product line and things like that are invaluable in marketing and positioning the company. And then in the due diligence process is much more streamlined because you can hand over the work that the seller's accounting firm has already done. And
mm-hmm.
it makes it a lot smoother for the buyer to go through that process. And the fact, like you've heard the old adage, time kills all deals. So the
Mm-hmm.
faster you can get through due diligence, the better.
Right. It's a little bit late to start your diet and working out when you show up at your honeymoon hotel. You kind of need to, if you're going to get any advantage out of that, you want to start pumping iron years in advance. So there's some work you can do well in advance.
That's a fair analogy.
So today, 2022 here, September, and I can't believe these years are just flying by here. September 8th of 2022. The market's been just white hot last year. The capital markets have been choppy. What are you seeing these days with this market right now? And if people looking to go, wow, there's always going to be M&A, but is it a little bit more uncertainty in today's market?
Yeah, it's been a roller coaster over the last couple of years.
Mhm.
Our firm from in 2020 when COVID hit, from February, which was before COVID, to May, the business dropped by 50%. And then there was the government stimulus, and the Biden administration started talking about raising capital gains tax. And so that the combination of the government stimulus and fear about taxes increasing created a very significant wave of M&A. And so
Mhm.
most investment banking firms that I'm aware of had record years in 2021 in
Mhm.
terms of number of deals, fees they earned. All the professionals in and around the deal environment were just crazy busy during 2021.
Mhm.
Valuations across the board were as high as they've ever been. And so
Mhm.
we all came into this year, 2022, um, A, tired, and B, expecting the same thing because the environment was very, very strong in January and February. Then we had the issues with stock market volatility, a very significant stock market drop. Um, in the March through May and June timeframe, which I think caused a lot of people to take a pause. And frankly, if you own a good business, it would not be wise to start a sale process in that time frame because
Mhm.
it's a 6 to 9 month process to sell a company, and you're selling into an uncertain market. And so
Mhm.
it caused a lot of people to wait. Then we've had the summer, and I think this is the first summer vacation people have had in 3 years. the COVID summer and the 2021 summer weren't really real summers because of COVID and the pandemic. So
Right.
there's been a lot of pent up demand for people taking vacations, traveling, et cetera, et cetera, et cetera. Um, and so we've seen the M&A market slow a bit over the summer.
Hmm.
Just in the last couple of weeks, as kids are going back to school, the stock market's starting to recover. People starting to get used to the new interest rates and inflation numbers.
Hmm.
We're starting to see a lot of interest in inquiries in M&A transactions, and so I don't think we're going to go back to the record year we had in 2021, but
Hmm.
we're seeing things just sort of generally across the board, stabilize, and it's feeling like a more normal environment. And
Hmm.
then the second thing I'm seeing, and I was in Dallas last week at a ACG conference where there were 700 people, tons of private equity firms and lenders, and what I'm hearing from the market is that it's now very, very sector specific. There are a number of sectors, a lot of B2B sectors, software, technology, et cetera, where the valuations remain robust, the market remains strong, M&A activity is high. And then there are some other sectors, in particular, consumer facing sectors
Uh-huh.
where there are concerns about interest rates, inflation, supply chain issues, some of the consumer privacy issues with Facebook and Google and marketing, where growth in those companies is less certain and investors are either paring back or valuations are coming down. And so
Hmm.
the M&A market, I think now there's a little bit of a flight to quality, and it's a little bit choppier. It's a little bit choppier sector by sector, but generally speaking, like sitting today, we're feeling like it's kind of a more normalized, typical market, and we're very optimistic about the rest of this year going into next year based on what we're seeing.
Okay. How much time do you typically need to properly, from the moment you first meet a client, sign them up, then get them ready and, target a sale within X number of, how much time do you need from being retained to closing a sale?
I think if there's a couple different scenarios here. A lot of times we have clients come to us where they have one or more buyers that are already a little bit interested.
Yeah.
And so that can be an accelerated process. But
Okay.
for a company that comes to us that's pretty well prepared, and kind of ready to go,
Uh-huh.
I always coach people that it's kind of a 9 month process, plus or minus.
Uh-huh.
We take 8 weeks, 6 to 8 weeks to put a CIM, confidential information memorandum,
Uh-huh.
together, work on their financial models and financial projections,
Uh-huh.
figure out which buyers we're going to go to, and just get all the materials and the process set up. And then the next phase would be going out to market. And in a typical process, we would go to both strategic buyers and we would go to private equity firms, probably calling more than 100 total buyers, to really make sure we're getting a good gauge of the market. That takes time, and so that's kind of another 8 to 12 weeks, and then we get initial offers, and then from those initial offers, we down select to a smaller group and get that, do more due diligence with a smaller group, typically up to 10 buyers, sometimes more, sometimes less, uh, and push them for a letter of intent, and then sign a letter of intent and close a deal. And that's typically, it can be as short as 6 months, it can be as long as 12 months, depending on factors that are kind of out of our control. But typically we work with clients and say it's a 9 month,
Okay.
process. A lot of companies that come to us aren't necessarily fully ready,
Mm-hmm.
and so there's some cleanup and other work that needs to be done before we can really formally engage. And
Yeah.
we work with companies on an informal basis, kind of helping them, and on a formalized basis, kind of helping them sort of be sure they're ready. And
Mm-hmm.
our firm spends a lot of time with clients, like understanding what their expectations are and making sure that the market can meet them, because it's a very distracting and labor intensive process to sell a
Yeah.
company. And so we try to make sure there's a very, very high probability of success before we get started.
So the deals that you're working on, there's not, you don't come to closing and have one big check rolling across the table and that's it, for done. See you next year. It's we've got multiple components. You're going to have some money held back in an escrow. You may have an earn out. You may have a seller carry note. You're probably going to have some rolled equity if there's a more sophisticated buyer. You want to talk about the various components of the purchase price?
Yeah, it's interesting, and I think a really attractive company that's an attractive asset that has strategic buyers really interested. In that scenario, you have a higher probability of getting like 100% cash at close type deal.
Oh, okay.
However, to your point, a deal is partly the price, and then it's partly the terms, and
Mm-hmm.
so there every deal has representations and warranties, and there's
Mm-hmm.
sometimes there's insurance policy, sometimes there isn't. There's money held back to secure indemnification obligations, et cetera. Most of the companies that we work with in the middle market also would have money held back in some way to make sure that key people are retained or key
Mm-hmm.
milestones are hit. So
Okay.
that's kind of what we're seeing on strategic deals.
Okay.
And then for private equity deals, that can be a really nice solution for business owners that want to take one step towards an exit but not have a full exit.
Mm-hmm.
So typically they're selling a portion of their company, typically
Yeah.
between 60, typically they would retain between 20 and 40%
Okay.
ownership. And
Uh-huh.
so they're getting they're turning over control, and they're getting a decent amount of liquidity at closing, and then
Yeah.
they retain equity. And typically the understanding is that the seller is going to remain involved and help the private equity firm continue to grow and build the business and
Mm-hmm.
have a true partnership so that they can continue to build and grow the value over time and then sell. One of the things that we've seen a lot in the last couple of years, and it's largely driven by COVID, where
Mm-hmm.
every company was impacted one way or another by COVID. Some companies had a decline in business, some companies had an increase in business. So one of the things that we're seeing is it's hard to look at the last couple of years of financial history for a company and understand truly what the financials are. So we're often seeing earnouts of some sort used to bridge that gap as a result of
Yeah.
the pandemic, and that's more common now.
They were properly, in a perfect world, gonna prepare to sell. What would you advise them today? Kind of a general strokes or tidbits that they can actually keep in mind and actually do.
It's a great question, and there could be hours of discussion on
Uh-huh.
on this topic, and so I'll try to just keep it high level. I think my experience is most of the clients we worked with show up not fully prepared to sell, and really don't have a full appreciation for the complexity and effort it takes to put together a good exit.
Mm-hmm.
And so there's a lot of elements that come together. I think there's some personal planning elements that are really important. Understanding like, hey, what is my number? How much? I own this business that I make money from it. It's my life. I'm going to trade that in for money. How much money do I need? How much money do I need to make this work to accomplish my life goals? And then there's personal issues.
Mm-hmm.
What am I going to do? There's family issues. A lot of people have kids in the business, or kids that want to work in the business, or other family members. Trading from owning an operating company to being an investor is fairly complex and tricky, and having that well thought through. There's a lot of estate and tax planning. The earlier some of these plans are put in place, they can have massive impacts on the tax consequences.
Mm-hmm.
So there's a lot of personal and tax issues. And then a second common theme is working the business. Let's make the business saleable, and let's make the business more valuable. Most business owners underinvest in their finance and accounting team, and as a result don't have really good granular reporting. The more you have really good, highly confident numbers and granular reporting, the easier it is to communicate the value to buyers.
Mhm.
I've worked with a number of companies where I'm the first person that's ever put together a budget or forecast.
Yeah.
It's very hard to put together a budget or forecast the first time
Wow.
and get it right. And so, having good budgeting and forecasting tools in place that are, and having predictability in the business is really, really important. And then another element that I think a lot of business owners come to is like, hey, I've got a great business, and I can go to a buyer, and they'll figure out what to do with this great asset I built. That's actually not how it works. A buyer is investing as much in the company, in most cases, in much in the company as in the management team and the strategy. And so having a really well thought out, articulated story and strategy that, like, hey, when I go to a buyer, this is how they're going to make a lot of money with my
Yeah.
business. Like, if
Hmm.
if I worked for them, this is my plan to make them rich or make them a lot of money, and really having that well thought out. We do a lot of that work, but the more it's fully baked and well thought out over a number of years, the
Right.
better. And so, to sort of sound rambling a little bit, but to sum up, I think really doing some homework and really understanding the complexity and preparation it takes to put together a successful sale is really important. Building a team of advisors and putting the right pieces in place personally and in the company is critical. And when we've seen that happen,
Hmm.
we've had amazing results for our clients, and that's really rewarding for everybody involved, including our client. And then when those pieces aren't in place, and we've all had the story where someone has an unexpected health issue or this or that, and they're forced to sell and they're not ready. Typically we can put a deal together, but it's not the amazing rewarding experience for somebody. It's
Right.
like, I have to sell my company and I didn't get what I want, but it's the best of all my bad alternatives, and
Mhm.
that's no fun for anybody. And so this preparation and homework and research and investing in the success of a sale
Mhm.
is critically important. If there's anything I can leave with the audience in terms of the business owners, it's really take the time to understand what it takes to have a successful sale and put the pieces in place and plan ahead.
Well, Channing, you're leaving our listeners with a lot today, and I really appreciate you sharing all of this wisdom and your experience with our listeners. And I welcome you to come back on again, and we can, maybe we can pick one or two more discrete issues, because there's just so much to this, and so much about the sale process, and this is so hugely valuable. It's, you do it right, and it's something that you read about. You fail to plan, then you better plan to fail, because it's you're going to leave a lot of money on the table if it's not done properly. So I can personally vouch for you that people who've worked with you speak highly of you, that you're a good fiduciary for business owners, and just really do a superb job of getting sales executed. So really appreciate your time this morning.
Yeah, David, I really appreciate the opportunity to be here, and anytime I can come back and help business owners be more prepared and more successful, that's what we're all about. So happy to come back anytime.
Excellent. Well, good luck with the triathlon. You're going to do a half Ironman this weekend.
Correct, and I definitely need some luck in my corner on this one.
And let's how far behind your wife do you plan to finish?
Yeah, I'm hoping to be waiting for her at the finish line with a smile on my face, but we'll see how it goes.
Okay. All
Yeah,
right. Well, then I
yeah,
guess that's competitive. That keeps a healthy marriage.
yeah.
Well, good.
I don't know if it's gonna work out that way, but
Okay.
we'll see how it goes.
I like it. A little trash talking.
Yeah,
Well,
yeah.
we're gonna let her get a sneak peek of this ahead of time here. So anyway, well, best of luck with you with it, and have a great time, and stay healthy, and work through those cramps. Hydrate. You know how it is. Have a good
Cool.
time. Have
Yep. Yeah.
okay.
Thanks so much for having me, and have a great weekend.
Okay. And everyone, thank you for joining us, and we'll see you next time on Selling Your Business with David King.